Let's get in Dr. Satyanarayana Chava, founder and CEO of Laurus Labs, for his conversation with us, as it happens every quarter. Dr. Chava, to you and everybody at Laurus, a very happy summer 2082. Thank you so much for joining in. Congratulations on a good quarter, but appreciate you talking to us today.
Thank you. Thank you. Nice talking to you.
Likewise, sir. Well, you're not in the business of giving guidance anymore, anyways, but a large investor who tracks your business told me this morning that I asked Dr. Chava, when will he hit 2,000 crores of profits, and then you can end the interview. Should we do that?
That's another way of dragging words out of my mouth.
Yeah, no, I know. I don't want to get that. But let's talk about how the first quarter and the second quarter and the first half went, Dr. Chava, because you guided to certain things around just a color around operational metrics, around some basic growth. Has it turned out as you anticipated, or did it turn out to be slightly better than what you thought?
I think it went as per our expectations. Two things we guided at the beginning of the year. One was gross margins. That's the indication of quality of business. For the last several quarters, we're well above 50%. Initially, we said we will have gross margins around 50. 2 years back, last year we said we will be around 55. This year, in the first 2 quarters, we demonstrated closer to 60% gross margin. Now we are happy to say that this financial year we will maintain around 60% gross margin. Last year, if you remember, we said for the entire year will be close to 20% EBITDA margin. We achieved that. And in the first 6 months of this financial year, we did 25% EBITDA. And we are confident that for the rest of the financial year, we will achieve 20% EBITDA at least.
So on the margin front, things look okay. You would do this, and you did well despite the share of synthesis dipping, I think, this quarter by 300 basis points. So, okay, that's commendable. Are you confident of, therefore, the actual EBITDA numbers easily doing better in H2 versus H1, Dr. Chava, part 1? And does FY27 on the EBITDA front and the gross, not the gross margin, but the gross profit front, look much better than FY26?
Yes, because of our current capex, except greenfield facility for bio, about 400 cubic meters of fermentation capacity. The rest of the capex is happening brownfield. We expect the utilization will be much earlier than a greenfield capacity. So whatever capex is coming, at least now we can say, we know what to make, when to make, how much to make in the capacity what we need. We believe FY27 should be better than FY26 with respect to EBITDA margins. Yeah.
And thereby, overall EBITDA and gross profits as well, I presume, will be much better. I mean, one, expanded capacities, but two, you will, as you said in the previous answer, all of those factors lead to better numbers as well on the whole.
See, we are little less than asset turnover ratio of 1, about 0.9.
0.9, yes.
0.9. We expect we will cross 1 in the next financial year for sure. Okay. So once that happens, so we will have a lot of positive things in our numbers.
Got it. The other standout, Dr. Chava, and please correct me if I'm wrong, is that your operating cash flow for the first half crossed the 4-digit number, if I'm not wrong, right? You were northwards of 1,000 crores, and correct me if I'm getting it wrong here. But therefore, the question that comes to mind is, as you're announcing new capex, whether in Vizag or otherwise, into newer areas or otherwise, and your debt equity, net debt to equity, circa 2 currently, you reckon a lot of your new capex can actually be funded by the operating cash that the company is now throwing up with the expanded capacities?
See, as we have seen, our net debt by EBITDA is 1.3. It used to be close to 3 2 years back. Now it is 1.3, and it will come down. So the cash profit what company is making should be enough for us to do at least about 1,000 crore capex every year. And if it is a very specialized capex, which we are doing, sometimes our partner gives advance as well.
Okay. So therefore, I take it, Dr. Chava, that for none of your current announced expansion plans or any kind of currently thought of acquisition plans, you will need to raise any major debt or do any equity dilution. Would that be a fair assessment?
We don't expect neither of those.
Neither of those things. Okay. Okay. Fair call. Now, there is also the Biosecure Act that has gotten revived last month. We didn't get a chance to talk to you post that. I wonder if that throws up newer opportunities for you, if it is predictable to do that currently. And does that tempt you to take slightly more bolder bets than what you've already announced? And for that, do you need to therefore take any kind of funding exercises? So two questions rolled into one.
See, the vendor diversification by Big Pharma, in my opinion, is already done. It's not that they will try to change vendors every 6 months. And they will not buy next 6 months material right now. So they are well prepared to take these kind of challenges. And I don't think any new positive surprises will come from any CDMO because of global challenges. Yeah.
Okay. And or opportunities.
Yeah.
I'm not just talking challenges. I'm also talking opportunities.
Opportunities. So global challenges will not use opportunities anymore. See, okay, I'll answer the question in two parts. The first one is, do people will add more clients because of the global challenges? I would say people added new vendors, but in my opinion, that is done. The second is, companies will change programs from one vendor to another vendor? That may happen. That may happen. And if it happens, the real growth will come at least 2 years from the initiation of the project transfer. So nothing new will come in the next quarter or in the coming 2 quarters. That's my take here.
I have 4 more minutes, Dr. Chava, so I'm going to do a bit of a rapid question answer with you. The first one is, with Roche, Eli Lilly, all setting up their or announcing a setting of their own shop in or around your region, but in India, is that competition for Indian CDMO companies who are getting businesses from these companies, that the newer business will not come to the Indian CDMOs, but will be done directly under the company's aegis?
I think the messages from these companies were understood differently. When we spoke to some of them, what they were talking, they are setting up technology centers to manage their CDMO partners. It's not that they are going to manufacture here. They are going to do tech centers, process chemist, analytical chemist, process engineers, quality control, quality assurance, to manage their partners. Instead of managing it from Europe or US, they want to manage it within India. I think that is a very good sign for Indian CDMO.
Okay. Okay. Thank you for clarifying that, Dr. Chava. And for your business as well, all the notes that have come in when I spoke to Varsha, my colleague who tracks this as well, it seems to be that what you always stated, that while ARV API gives you that baseline, CDMO gives you that growth chutzpah. And every note is saying that CDMO will be the cornerstone of Laurus's EBITDA growth and overall growth. Animal health, human health, whatever. Do you foresee the contribution of CDMO to go up to 50% next year itself? Could it happen gradually? How would you tell us?
It will not happen next year.
Not next year.
It will happen gradually. It will happen gradually.
Okay. Okay.
But
okay.
it will go there. It will go there.
But you will go to 50. And will it be driven by animal health, or do you reckon that in the very short period, human health products also come into the fray?
I think majority of the growth will be driven by human health products.
Human health products. Okay, fine. So, but the animal health capabilities will start showing from FY27. I believe your last presentation said that FY26 might be okay, but FY27 will see a big ramp up in animal health. Would that be fair?
By end of FY27, all the products what we wanted to validate will be done commercial validation completion. So we expect FY27 will see good growth in animal health, and we're also talking some projects on crop sciences also. So animal health will go to sustainable mode FY27 and FY28, and whereas we need a couple of more years to do some sizable business in the crop sciences.
Got it, sir. My final question, return on capital employed on an upward trajectory, Dr. Chava. Do you reckon that from this 13% number that you were at in FY25, could you nudge high teens or even 20 in the next couple of years? ROC of 20%?
Definitely. In the next 2 to 3 years, we will be somewhere between 20 to 25, for sure.
20 to 25% in the next 2 to 3 years. So let's say by FY29, you could actually be at a number as high as 25 also. It could be 20, it could be 22, but it could also be 25.
Yes, yeah. We were giving a broad range. That's the direction we are moving.
Got it. Okay. Dr. Chava, lovely talking to you as always. Thank you so much for taking the time out and being with us, and all the best for the quarters ahead.